Everyone in crypto dreams of catching that one project, the next 100x opportunity that turns a small investment into a fortune. But the harsh truth is this. By the time it's trending on Twitter or featured in YouTube thumbnails, the real money has already been made. The biggest gains don't come from hype. They come from recognizing growth before the crowd. The investors who identified Solana, Avalanche, or Arbitrum early didn't have insider info. They had the ability to read signals the market ignored. Subtle signs like rising developer activity, increasing total value locked, or steady wallet growth often reveal the next big ecosystem long before price action confirms it. In this video, we'll break down the exact on-chain and fundamental metrics that professionals use to detect early ecosystem expansion. The same data points that can help you spot the next major breakout before everyone else even knows it exists. Most investors miss 100 times opportunities because they chase stories instead of signals. They rely on social media buzz, influencer hype, and price charts, all of which lag behind the real action. By the time a token is trending or a narrative dominates crypto Twitter, early investors and venture funds have already built their positions months in advance. Take Solana as a clear example. In early 2021, when the majority of the market still dismissed it as just another chain, early wallets that accumulated at $1 to $3 later saw returns exceeding 100 times when SOL reached $200. The signals were there long before the hype. Developer activity was rising rapidly, new dApps were launching weekly, and liquidity was flowing steadily into Solana-based protocols. But retail traders ignored those metrics and waited for headlines. And by then, the easy gains were gone. The truth is, crypto ecosystems don't explode overnight. They build momentum quietly through developers deploying code, users bridging assets, and liquidity entering protocols. Smart investors focus on this early-stage growth, not short-term price moves. The market doesn't reward those who follow trends. It rewards those who can recognize momentum beneath the surface before anyone else sees it. When most people hear ecosystem growth, they think of price rallies or new token listings. But true ecosystem growth happens before any of that. It's the silent stage where builders, capital, and users start converging around a specific blockchain or platform. Real growth begins with activity, not attention. An ecosystem grows when developers consistently deploy new contracts, when protocols attract liquidity, and when users start interacting with dApps daily. It's a bottom-up process, and often invisible to the average investor because it happens behind the scenes, on-chain. For example, before Arbitrum's explosive launch in 2023, there was already a quiet surge in smart contract deployments, bridge inflows from Ethereum, and stablecoin transfers within the network. Those who were tracking this data could see clear momentum building, long before the token dropped and retail piled in. Ecosystem growth is like watching roots before the tree appears. The fundamentals, developer engagement, user retention, liquidity stability, grow first, and only later does the price reflect that strength. When multiple signals align across these layers, it's a strong indicator that an ecosystem is maturing into something the market will eventually recognize. To identify 100x opportunities before they become mainstream, you need to focus on data that reveals early traction, the quiet signals that come before the hype. These metrics don't just show activity, they show momentum. Let's break them down. Number 1, developer activity. The first sign of real growth is always developer interest. You can track this through GitHub commits, new smart contracts deployed, and developer retention across a network. When more builders start creating on a chain, it means the infrastructure is maturing and the opportunity space is expanding. For example, before Polygon ZK EVM went viral, developer activity on its repositories had already surged, showing commitment long before retail noticed. Similarly, early Cosmos SDK adoption signaled the foundation for multiple successful chains before the modular blockchain narrative exploded. Number 2, total value locked TVL acceleration. TVL measures how much capital is committed within an ecosystem's DeFi protocols. But what matters most is the rate of change, not the number itself. A consistent rise in TVL, even from small bases, signals growing trust and confidence. For instance, Avalanche's TVL quietly rose from under $100 million to over $1 billion in mid-2021, months before AVAX reached its peak, as liquidity providers and protocols migrated there, seeking faster yields and lower fees. Number 3. Wallet growth and active users. New wallets interacting with a chain show adoption. When daily active users and transaction counts rise steadily, it's a strong sign that real usage, not speculation, is driving growth. Before Base, Coinbase's Layer 2 gained public traction, on-chain data showed a steady climb in unique wallets and bridge activity. Those monitoring it early could see the user base forming long before marketing began. Number 4. Liquidity flow and stablecoin inflows. Follow the money, especially stablecoins. When USDC or USTD inflows rise on a new chain, it means capital is positioning early for opportunities. Ahead of Solana's 2023 rally, stablecoin liquidity on Solana DEX like Orca and Radium doubled within weeks, even as overall sentiment was bearish. Whales often bridge stablecoins first, signaling where the next rotation of capital will occur. Number 5. Ecosystem funding and partnerships. Lastly, track funding rounds, grants, and strategic partnerships. Venture capital allocations, hackathon funding, and ecosystem incentive programs often precede massive expansions. Before Optimism's breakout, it received major ecosystem support from a 16Z, Paradigm, and multiple DeFi projects migrating from Ethereum, creating the foundation for rapid growth once its token launched. These metrics, developer traction, capital inflows, user adoption, and ecosystem funding, are the early warning system of innovation. They don't tell you what's hyped, they tell you what's happening. When several of these begin rising together, it's often the first spark of an ecosystem that's about to explode. Once an ecosystem crosses a certain threshold of builders, users, and capital, it starts to feed on itself. This is the network effect in action. Every new developer attracts more apps. Every new user attracts more liquidity, and every new project adds more utility for the next wave of participants. It's exponential growth, not linear, and it's what separates 10x projects from 100x ones. In crypto, network effects are incredibly powerful because ecosystems compound across multiple layers: liquidity, users, and developer tools. Take Ethereum, for example. It didn't become dominant because it had the best marketing, but because every new protocol like Uniswap, Aave, or Compound made Ethereum more useful and more liquid, attracting even more developers in a self-reinforcing loop. We saw a similar pattern with BNB Chain in 2021. It started with a few DeFi projects but exploded as low fees attracted users, which then drew developers to build more apps, fueling even higher user growth. By the time retail noticed, the ecosystem's momentum was unstoppable. That's the secret. You don't chase network effects, you identify them forming. Early on, it looks like quiet growth, small increases in transaction counts, gradual liquidity expansion, consistent developer commits. But when those lines start curving upward together, that's when exponential scaling is about to begin. At the end of the day, finding a 100 times project isn't about luck. It's about understanding where real growth begins. Most investors chase tokens when they're already trending, but by then, the asymmetric opportunity is gone. The real edge comes from seeing the signs before the crowd. When an ecosystem is still young, the builders are quietly active, liquidity is starting to flow in, and users are beginning to engage organically. Every major winner in crypto, from Ethereum to Solana to Arbitrum, followed this same invisible curve. They didn't explode overnight. First came the developer foundations, then capital inflows, followed by rising user activity and compounding network effects. The investors who watched those metrics instead of headlines were the ones who entered early and held conviction while everyone else was still skeptical. Remember, price is the last thing to move. Before every rally, there's data, on-chain footprints showing where the energy is building. When you study metrics like TVL acceleration, wallet growth, stablecoin inflows, and developer activity, you're essentially reading the early heartbeat of innovation. It's not glamorous work, but it's how the smartest investors spot opportunities that can multiply 100-fold. So next time you hear about a new ecosystem, don't ask, is it trending? Ask instead, are developers shipping consistently? Is liquidity growing steadily? Are users returning daily, not just speculating? Are major players quietly funding or building here? Those are the clues that separate a fleeting hype cycle from a true technological movement. Because in crypto, the market doesn't reward the loudest, it rewards the earliest who understand the quiet signals. Learn to read those signals, and you won't need to chase 100 times projects. You'll already be positioned in them before anyone else even notices.